On behalf of Crosscheck Media and Biz Talk Today TV, welcome everyone to the Money Path. I am your host, Todd Schoenberger. With me today is Eric Pachman. He is the Chief Analytics Officer at Bancreek Capital Advisors. Eric, you've been in the news. You've been very public recently. I would say probably over the last year, actually, talking about the distortion with the labor market. As you know, next Friday we have a very critical labor report that will be coming out. But you're saying that there's one specific sector that is actually distorting the numbers. Can you tell the audience which sector that is and why?
Yeah, so the sector is called healthcare and social assistance.
Okay.
So I'm not sure if your listeners know this, but if you go to bancreek.com, all of our work there is free. All of the research is free. And what we're known for is our data visualizations. And so the data visualization that's been getting a lot of attention lately is called a tree map. So it allows you to, over different time periods, over 1 month, over 1 year, 3 years, all the way up to 20 years, it allows you to look at the change in non-farm payroll data that's published by the BLS, which is the data point that you talked about coming out next Friday.
Okay.
So if you look at this, I have to tell you, Todd, I have no particular expertise when it comes to this. I know how to put together databases, so I'm very good at that. And I know how to ask questions of those databases.
Okay.
But it doesn't take a rocket scientist to look at the visualizations and look over the 1 month period, the 1 year period, the 2 year period, the 3 year period, and be like, what is this giant green box? There's like one giant green box, and it's healthcare and social assistance. And it's over almost every time period that you look at it. It's punching way above its weight class. It's only 17% of all jobs in this economy. That used to be around 10%. Now it's 17%, but it's been responsible for 66% of all job growth over the last 2 years. So for the
Wow.
last year, and that's been getting worse. So that number was like 50% a year ago. And we were flagging like this is not the picture of health for the labor market.
Yeah.
Professional and business services, which is where consultants are, which is where lawyers are, accountants, the people that are doing coding, those had plateaued already in the middle of last year and are actually in decline, which is the first time we've ever seen that in the data going back almost 100 years without a recession. I'm sorry. It happens during every recession, but never happens outside of a recession.
Okay.
Leisure and hospitality is plateauing. Manufacturing is in secular decline. Retail is in decline. Everything else screams that the labor market is suffering and has been for a year. This is not a surprise for anybody that's been following our work at all. It's just now that those other sectors are getting even worse, and healthcare is finally starting to run into problems. And we haven't yet seen that within the BLS data, but ADP publishes a payroll survey as well, which
Right.
I would argue is probably better because it's a direct data feed and it's a larger direct data feed as far as number of employers versus a survey by the BLS. I'll always take direct data over a survey, right? And that has shown that healthcare has lost about 100,000 jobs this year versus gained like 500,000 jobs. So we have the largest, and we've written about this, but it's the largest divergence in these two measures of employment for healthcare in the history of the data. It hasn't happened before outside of a weird brief spike and then correction during COVID. If you take that out, there's never been a structural disconnect this large. So we have measures that are screaming that healthcare is already in decline right now.
Okay, so let's expand on that then. If I strip out healthcare and the social services side, are you trying to tell me or telling the audience that the labor picture is actually in recession now?
Yeah, look, I mean, looks exactly like it. There is almost no job creation at all. And in
Wow.
fact, like the trends look very disturbing. The only one that arguably looks okay is leisure and hospitality. But I mean, I try to think, and I'm, anyone can come up with their own views on this. But my observation of like, Chipotle or a restaurant or a hospital, or not hospital, I'm sorry, a hotel
Yeah.
is they're kind of like second order effects on primary industries. So if I have disposable income to spend because I have these wonderful healthcare jobs that have been growing through and through every single recession, then I will have more income to spend traveling and eating out and all those kind of things. So that has been relatively robust. But outside of that, when you actually look at what I would call more primary industries, like, yeah, I mean, there's really no bright area. And don't take my word for it. Go look at the data. I mean, every now and again, you'll find a bright spot, But you can hover over any of those little boxes in our data visualization, and you can look at the long-term trend back to 1990, and you just won't find a lot of positivity there outside of healthcare.
Yeah, though, and I think you're being a little bit modest too, how anybody can find you. You did go to HBS, so you definitely have a you know how to analyze it. So, but let's go further than this then, because the Fed, as you know, cut rates for the first time this year, primarily because not that inflation is in check, but really that you have a weakening labor market.
Yeah.
So it sounds to me what you're saying is that the Fed is way too late in cutting rates. I mean, is that your opinion?
Um, I think it's worse than
Oh
that.
my.
So,
Woo!
so here's, yeah, I know, right? Let me get people's attention. So, I put out a report called The Demise of the Dynamic Duo a little while
Okay.
ago. And that was spurred by a quote from Jerome Powell, which said that he said at Jackson Hole while everybody was like ignoring it, waiting, saying, hey, forget all this stuff you're talking about. Like, tell me what you're going to do with rates. But while everybody was kind of like skimming through his prepared remarks, he said, and I quote, monetary policy can work to stabilize cyclical fluctuations, but can do little to alter structural changes. And
So
so
what's the point then?
that stopped. Yes, that's it. That stopped me in my tracks. So
Yeah.
everybody is kind of looking at the history that we know and we've lived through. It doesn't really matter how old you are. The history that we've all lived through has been one in which monetary policy has been able to make our way out of kind of cyclical declines, right? But the last time this was actually tested, let's be honest, was 2008. Like COVID does not count because we injected trillions of dollars directly into people's bank accounts. So,
Yeah.
I mean, like we could do that right now, and I'm sure everyone would be very happy. And it really wouldn't matter what was happening with monetary policy. In 2008, that's a long time ago, right? I mean, we're going on like 17, 18 years. Healthcare was much smaller, professional services was much smaller. We were more cyclical than we are now. A lot of other different situations. But before then, I mean, you're going back to 2001, then you're going back to the 90s. I mean, like we don't have a lot of data points at the end of the day. But right now, what are the challenges that we have? So, like, form your own views on this, listeners, right? But my views are that the major economic challenges that we have are all cyclical. We have healthcare, which has been a disproportionate grower of jobs within our economy, which is in the crosshairs of this administration right now. The one big beautiful bill is set to cut $1 trillion. There's an article that just came out from Modern Healthcare that said that hospitals are already laying off administrative staff in preparation for this. It's already happening, right?
Wow.
So this is a structural thing. Healthcare and all the evils that people hate about healthcare has created a lot of profit, which has created a lot of jobs. And so we can't just go and kill healthcare and make things right for people. I wish we could, but if we do that, the system's almost too big to fail. It's like the banks in 2008. We are going to have casualties, and I mean jobs, if we do that. That's a structural problem. Nothing the Fed can do about that.
Yeah.
AI is a structural problem and whatever impact it has on jobs. Immigration in the policy right now with immigration. I did a piece that you can also get for free on our website, where if you look back over the last 18 and a half years, we had this huge aging of the US born workforce. So the US born civilian population went up by 67%, but the overall US born population only went up by 8%. Well, that's a really bad thing because when you get 65 and over, what do? You want to retire, right?
Hmm.
And so the labor force participation rate of the 65 plus for US born is only 18%. So all we have is a weighted average issue here. This is just math. Math doesn't care about your views on immigration, right?
Right.
Once you get over 65 plus, you are going to drag down our labor force participation rate. But we've had this influx of immigrants over the last 18 and a half years that have brought 9 million jobs to this country, which has offset that and kept the labor supply balanced. Note when Jerome Powell is talking, he is constantly talking about the impact of immigration. He is constantly talking about risk to the labor supply, which everyone is ignoring. I think this is one of the biggest risks out there because go to the census.gov website and you will see that this problem only gets worse through 2100. Like we have a structural demise of our kind of labor force because of the aging of the baby boomers and so on and so forth. And so this happens to civilizations all the time, and it is happening to us. And we need immigrants in order to offset that. in order to keep our labor supply tight, because if it declines, that's structural inflation that the Fed cannot control.
Right. I get a couple of things here. Let's unwrap this. So the with Powell, Chairman Powell talking about the structural side as related to monetary policy, he is somewhat correct though. I mean, even if they're cutting rates doesn't mean that companies are going to go out and hire. Where monetary policy has more influence is likely on inflation. But with this though, with inflation and the amount of risk that we're looking at here, at the end of the day, it's still inflation actually does help companies, publicly traded companies. So from the stock market, what
Yeah.
you're suggesting is really a doom and gloom scenario on the labor picture, which would impact the economy. But if inflation is rising, that does actually help with top line numbers for companies and therefore should help the stock market. So
To a
where's the
point.
give and take here then, Eric? I mean, are we
Yeah.
looking at still a rising market, but we're looking at people out of work, or will we have a balance maybe in 2026?
Well, Todd, so I really, I'm going to do it anyway because you asked me, and I love this question. But I want to caveat this that I hate trying to time things. Like,
Okay.
I've laid out my view longer term with markets, but that doesn't necessarily mean that I think they're headed down right now. And the reason is what you pointed out, but it goes even beyond that, right? So if I had to guess, and of course tomorrow I may have a different view based on something else that happens, but at this moment, if I had to guess, AI has barely been tapped by, call it traditional industrial type companies yet,
I
like the
agree.
true potential of AI. And so if we are going into a world where the recession gets worse, or let's call it the labor market. It may not be a recession because we have all this AI capex growth, right? But the labor market gets worse and worse and worse. And the Fed keeps trying to cut further and further and further. Then you could have one of these scenarios where it's like, well, and inflation is going up. You could have companies that are all of a sudden bringing in the Accentures of the world saying, how do we leverage AI to cut out as many jobs as possible to pad the bottom line, right? I've worked in many operating companies before, and they tend to be late adopters to this kind of stuff when the market forces are kind of pushing them towards it. And so they're going to bring them in, and they're going to be like, oh yeah, you can easily get rid of this, all these things. Well, then that just makes the labor market even worse.
Hmm.
And as inflation is going up, the Fed is going to have this balancing act of like, well, the labor market is getting, worse in the near term, but potentially tighter in the long term as immigration is cut down. The tariff impacts haven't been felt yet. It's just this giant, mess, like a bunch of spaghetti against the wall. But if they are consistent in focusing on the labor market, they keep cutting. People get more excited about risk assets. Companies' profit actually goes up. And then, by the way, when people get laid off, like this is a little bit of a cynical view, but like, what do you do if you're like mindlessly looking for a distraction? You go to your phone, you surf on social media. I wouldn't be surprised if profit got better for big tech as this all goes up and people have more disposable time to
Huh.
just basically spend on their devices. Because if I'm a marketer and I'm like, do I want to spend money on traditional media or do I want to spend money? Well, now I'm looking at kind of the metas of the world and I'm like, well, their metrics are actually getting better. Their user engagement is getting better because people no longer have jobs. And so, but this is a slippery slope that we're on, right?
It
I don't
is.
want to trade into this at all because I can't time. All of a sudden, the markets are very smart. They just all of a sudden change their mind one day and decide to focus on one thing like rising profits in big tech to all of a sudden crushing the multiples because they can see that this is eventually going to end badly. And I have no idea nor any edge on when that actually happens. Only that is kind of a path that I could see happening now, which is actually quite confusing on what to do if, as I've been saying, you have a little bit of FOMO and you don't want to walk away from this super hot craps table that's had 10 points in a row. If you've ever been to Vegas, I mean, everybody's screaming and throwing money around and everything like that, but the seven's going to hit and clear out the table eventually. When's it going to hit? We don't know.
Right, right. And earlier you did mention about the population shift where you have more the birth death model is definitely inverted at this point because to this year, as you know, 2025 will be the first year where our population in the United States for the first time in its history will actually see a decline, and that is really because of the immigration side. But let's take this a step further, though, because you're talking about the rest of the 21st century when you look out long term to thinking, obviously for the next 75 years. We're looking talking about healthcare. What about the education side? When you have less people that are being born, less kids that are being born, you would think that that would have a direct impact to higher education. What's your opinion there? Do you see potentially in the next couple of decades, maybe colleges having to merge, maybe going out of business? I mean, they're nonprofits, but what do you think?
Oh, it's a great question. I haven't written about this yet, but I certainly have views, which now that you put me on the spot, I'd be happy to talk about. So I think you're already seeing this, right? I mean, you're seeing kind of the middle tier. This is kind of what's happening with the middle class in this country in general. Like you either have feast or famine in this country in almost everything, in healthcare and education and income. And so you're seeing these kind of middle tier private colleges that are going out of business already
Mm,
or really, really struggling. And then you have the flagship state universities, which are largely thriving in this environment
mhm.
because, and I just sent my oldest son to Ohio State.
Ah,
You can't compete with it. It's very, very affordable for in-state, right?
yeah,
And so, and there's really no way when you're actually doing the math that you can make any sense. Like he really wanted to go to like Illinois, as an out of state, but there's no way that he can ever get a payback on that. So like, why would you ever pay $60,000 versus $25,000 when you're going
right.
to get maybe like 5% more if you're lucky coming out of college? It just makes no sense if you know anything about how to do like a present value calculation,
Right.
which I taught him how to do. So anyway, you have that, and then you have like the ultra kind of elite universities that are able to charge $100,000, and because you have so much wealth that's accumulated by such a few number of people that $100,000 a year is insignificant. It's like, of course I would do that, just so I can brag to my friends about it, or like whatever it
Yeah.
may be. Like there is no present value calculation of sending someone to, let me pick on it, Vanderbilt.
Okay.
I mean, for $100,000 a year, at least relative to like an Ohio State. So I think you're already seeing it. But yes, I mean, as we kind of move out, and I mean, I'm thrilled that you asked this question because who really cares about 10 years from now, right? But like for the people that do, yeah, you have this slug of kind of um, undereducated, or, I'd say there was a piece that Derek Thompson just put out today in plain English. He's wonderful, right? I mean, hopefully your listeners listened to him. That talked about like AI being the beginning of the end of thinking in general. Like it doesn't encourage us to flex our creative muscles, which requires doing things the hard way. Like at least it did for me, and my entire experience is you have to, like, back in the day, go to the card catalog and pull out the thing, the card, and then find it, and then go back and be like, that wasn't there. Like, I mean, all those things have value in developing your creativity and actually working with an Excel spreadsheet, actually learning how to code. You don't have to do these things anymore. And so the ability to think and be creative is going to be impaired, I think. I know it's very controversial to say that, but then it's like, well, what does college even look like? How are we preparing our kids through elementary school, middle school, high school in order to be active participants in the labor force, which, by the way, by that point in time, if I'm right about my near-term view of the market, entry-level positions will be gone anyway. And so, like, what
Oh
jobs do they
my.
even have that are required? Like, I started in an entry-level position, and I guarantee you my job could have been replaced at ExxonMobil by AI. But you know what I learned? I learned corporate dynamics. I learned how to deal with the politics of an organization. I learned how to make presentations. I learned all the soft skills that
Yeah.
now allow me to communicate with you and other people, to write well, like all these things. Where are those skills going to go? Makes me very, very terrified about the future of our workforce.
Yeah, that's a valid point. That's a very valid point. So in the time we have left, let's talk about let's switch gears here to the Bancreek your ETFs. Now, what do you because your models and everything that you're analyzing here, I mean, do they mimic? I mean, is that what investors can expect out of the ETF side?
You mean, do they mimic my views?
Yeah. Well, not your views, but clearly, I mean, your analysis here has to be
Yeah.
taken into place
Yeah,
when it
yeah.
comes to the management of those
Well,
ETFs.
so it is confusing because like I am freed up to do a lot of this very high level data visualization, analytical thinking. And then my goal is to provide this to the general public for as long as we can, free of charge. So we are able to be of service to everyone that is involved in markets, whether it's a commodity trader or a macro trader or someone in education or whatever it may be. Not everybody wants public equity exposure, especially through ETFs, right? But there's a large chunk of the world, of the financial world, a huge slew of RIAs, people that have been in mutual funds and are transitioning over, that are no matter what I tell you, are going to have US equity exposure. And it just makes sense to do it within an ETF because of the tax efficiency now and because it's cheaper. Or they're going to have international exposure. And so we are trying to serve different groups. We do take my views into account, trust me. We don't have many healthcare companies that we're holding because I've kind of overridden those within our models.
Okay.
But we have developed a systematic approach to selecting companies with what I would call, and this is a longer discussion, institutional endurance. So companies that have been able to endure different environments, strong management teams, all the kind of quality factors that you would look for. But the way that we're different is we're doing that by actually using quantitative screens in order to find that. Now, these aren't ones that you can find anywhere in the public. Like, we have developed these over years of research through using information theory, like lots of complex mathematics, in order to kind of distill out which signals can we get from stock price, from all this quantitative information that can point us to companies that are higher quality. And we are just choosing the top 30 at any given point in time, with the overlay that, if the history is no longer a predictor of the future at all, which I think is very true for the healthcare industry, then we're probably not going to trust the historical data that our models are trained off of for those specific sectors. So we do have this overlay where we're sitting on top of it, monitoring it to make sure that it aligns with our views. Now, you may come away from this being like, I don't want any public equities. Well, then there's no point in buying BCUS, which is our US, exposure.
Mm-hmm.
Or you could think, the S&P 500 has become super concentrated. Part of my mandate as an RIA is to have US exposure. Maybe I should diversify to something that looks very different and is approaching this and doing stock selection from a very different perspective to get me diversification. Then you'd be very interested in BCUS. Now, I am very bullish, relatively, international developed market equities. They don't have a lot of the challenges that we have, which we just talked about. And we also do have an international ETF, ticker BCIL. It's only developed markets. So we're scouring the globe, a universe of over 5,000 equities to try to find just the top 30 at any given point in time. And so I'm really excited about that product, especially given the environment that we're in. So I tend to encourage people to investigate that. Or if they're not even interested in that, like, make sure you are looking at passive international exposure right now. All eggs should not be in the US basket unless you're trying to time it. And then if you're trying to time it, go find another podcast to listen to, because at least maybe the next guest that you can have, it's not me.
No, we're definitely going to have you back. I mean, this was a great conversation, and I know that the audience is getting a ton out of this. So I love the analysis. The deep dive into it is fantastic. So, but we are going to leave it there on this block, though. So Eric, thank you for joining me on the Money Path. Can't wait to have you back. We got to have you back before the end of the year, because we got to really break down the next few labor picture reports that come out.
Happy to, anytime, Todd. This was fun.
Absolutely. So on behalf of Eric Pachman, and you can go to bancreek.com for more on the research that's provided for free from Eric, as well as take a look at their ETFs. I know you'll get a lot out of them. So on behalf of Eric Pachman and I'm Todd Schoenberger, and we thank you again for joining us for the Money Path. We'll catch you next time. Take care. All right, we're out. I'm sorry about the ending there.
Oh yeah, that was probably the most fun I've ever had on a podcast.
Really?